The silver flash crash. What really happened and what it means. If you follow commodity markets, you probably noticed something unusual last week. Silver experienced one of its sharpest intraday declines in recent memory, dropping over 5% in just a few hours before stabilizing at lower levels. For traders watching their screens that morning, it was a jarring reminder of how quickly markets can move. But what actually caused this dramatic price action? And more importantly, what does it tell us about the current state of commodity markets? Today, we're going to break down the mechanics behind this move, examine the factors that set the stage, and discuss what business leaders and investors should take away from this event. Understanding modern silver price discovery. Before we dive into what happened, we need to understand how silver prices are actually determined in today's markets. Most people imagine a straightforward process. Miners extract metal, industries need it for manufacturing, investors want it for portfolios, and supply meets demand to establish a price. The reality is considerably more complex. In modern markets, silver prices are primarily determined through derivatives, financial instruments that represent claims on silver rather than physical metal itself. Futures, contracts, options, and exchange-traded funds collectively dwarf the physical market by significant margins. On any given trading day, the volume of paper silver changing hands can exceed entire months of global mine production. This creates an interesting dynamic. Price movements can be driven by changes in derivative positioning that have little to do with physical supply and demand fundamentals. When leveraged traders holding futures contracts decide to exit their positions, they don't need to find buyers for actual metal. They simply close their paper positions. When many traders do this simultaneously, prices can move dramatically. That's precisely what happened during last week's decline. The mechanics of the drop. The silver crash wasn't mysterious or random. It was the predictable result of how over-leveraged positions unwind in derivative markets. Large speculators had built substantial long positions, bets that silver would continue rising over the preceding weeks. As prices began declining for various reasons we'll discuss shortly, some traders faced margin calls and were forced to sell. Others chose to take profits after the recent rally. This selling pressure triggered stop-loss orders, automated instructions to sell when prices fall below certain levels. The result was a cascade effect. Selling triggered more selling, which pushed prices lower, which triggered additional stop-losses. High-frequency trading algorithms detected this movement and amplified it, adding fuel to a fire that was already burning hot. Here's what made this event particularly noteworthy. While paper prices plummeted, the physical market told a different story. Dealers reported that demand for actual silver coins and bars remained steady, with some noting increased buying interest as prices fell. Refineries continued normal production. Industrial consumers maintained regular purchasing patterns. This divergence revealed an important truth. The price drop was primarily a derivatives event, not a fundamental rejection of silver's value. What set the stage market crashes rarely happen in isolation. They typically require a buildup of pressure across multiple factors that eventually reach a tipping point. In silver's case, several conditions aligned in the weeks before the crash. First, positioning data showed an extreme imbalance. The weekly commitments of traders report revealed that speculative traders had built their largest long positions in over a year, while commercial hedgers had reduced their shorts. Historical patterns suggested this imbalance often preceded sharp corrections. Second, the U.S. dollar had been quietly strengthening against major currencies. Since commodities are priced in dollars, a stronger dollar makes them more expensive for international buyers and generally reduces speculative appetite. Related to this, real interest rates, nominal rates minus inflation expectations, were rising. This mathematical shift changed the opportunity cost of holding silver, which generates no yield while sitting in a vault. Third, industrial demand signals from China, the world's largest silver consumer, showed signs of slowing. Manufacturing activity had decelerated, and solar panel production growth, one of silver's fastest-growing demand sectors, had cooled from its previous pace. Fourth, mining companies reported better than expected production numbers, easing concerns about physical supply constraints that had supported higher prices. Finally, the options market created its own dynamics. As monthly options expiration approached, dealers who had sold call options needed to adjust their hedges. The same hedging mechanisms that amplified moves higher during the rally worked in reverse as prices peaked and began falling. None of these factors alone would have triggered a crash, but together they created structural vulnerability, a market that was over-leveraged, overextended, and sensitive to any catalyst that might trigger unwinding. Broader market context: the silver decline didn't happen in a vacuum. Careful observers noticed other concerning signs in global financial markets around the same time. Gold, silver's monetary cousin, barely moved while silver plummeted. This divergence was significant because historically both metals moved together during genuine flight-to-safety episodes. Their decoupling suggested something specific to silver's dual nature as both industrial metal and monetary asset was under stress. Overnight lending markets showed brief spikes in rates, indicating that liquidity wasn't flowing as smoothly through the banking system as surface calm suggested. When banks face funding pressures, commodity trading desks are often among the first areas where leverage gets reduced. Currency markets exhibited unusual behavior, with emerging market currencies experiencing volatility spikes. Corporate credit markets also showed signs of stress, with spreads widening for companies in commodity-dependent sectors. These signals suggested the silver crash was symptomatic of broader tensions in the global financial system, nothing catastrophic, but enough to warrant attention. Strategic implications. So what should business leaders and serious investors take away from this event? The most important lesson is distinguishing between price and value. Price is what something trades for at any given moment in derivative markets. Value is underlying worth based on utility, scarcity, and fundamental supply-demand dynamics. During the crash, silver's price changed dramatically within hours, but its industrial applications, physical properties, and consumption rates remained unchanged. This created a temporary dislocation between reality and perception. Second, the event highlighted the difference between paper claims and physical assets. The volume of paper silver traded daily exceeds available physical metal by vast multiples. This works fine in normal times, but during stress periods, not all claims can be simultaneously fulfilled. Companies that depend on silver for manufacturing should consider whether futures contracts or physical inventory better serves their supply security needs. Third, the crash demonstrated the importance of understanding market structure. Short-term price movements are dominated by derivative positioning, algorithmic trading, and leverage dynamics. These factors create noise that can be safely ignored by strategic long-term thinkers focused on multi-year trends in industrial consumption, mining economics, and monetary policy evolution. Fourth, volatility appears to be increasing across financial markets, driven by monetary policy uncertainty, geopolitical tensions, and economic transitions. This environment rewards financial resilience, maintaining liquidity to avoid forced selling, avoiding excessive leverage, and structuring positions so adverse moves are uncomfortable but not catastrophic. Conclusion. The silver price crash was dramatic, but it wasn't mysterious. It was the natural result of over-leveraged positioning unwinding in derivative markets against a backdrop of shifting macroeconomic conditions. For those who confused price action with fundamental value destruction, it appeared catastrophic. For those who understood the mechanics at work, it was simply volatility, uncomfortable, but not surprising. The broader question isn't whether silver will recover or where it trades next week. The broader question is what this event reveals about the operating environment we're navigating. Markets are complex systems where paper claims can temporarily diverge from physical reality, where leverage amplifies moves in both directions, and where structural vulnerabilities build gradually before resolving suddenly. Understanding these dynamics won't help you time the market perfectly. No one can do that consistently. But it will help you maintain perspective during volatile periods, distinguish signal from noise, and make strategic decisions aligned with long-term value rather than short-term price fluctuations. That's the real lesson from silver's wild ride.